Hey, and welcome to Chasing the Joneses. While the world is changing, some things never change. You still need to work hard and take a few risks every now and then to achieve anything decent. But what if wealth in the future looks different? With so much uncertainty, how can we have the wealthy life today and tomorrow? In this series, I'll share views and strategies that everyday people use to build wealth. And the good news is, it doesn't come from a book. It comes from real life. Once your money thing is sorted out, on the way to chasing what you think success is, you might just learn how to surge ahead. So, if you're ready, let's go. Hey everyone, welcome to this episode of Chasing the Joneses. Today I'd like to chat to you about why some people invest, or I guess, talk about their investing personas. Then I want to talk to you about what happens when you do invest from a simplistic point of view. It's going to be pretty straightforward today, nice and light and simple. Now, some invest like it's their favorite sport. They choose their team, they analyze the rules, and they take joy in the score. They invest to win, and the results aren't nearly as important as how it makes them feel when they're engaged with it. It's more than their hobby, but it's not too dissimilar to a hobby. They love sharing their victories, and they're always preparing for the next big bet. Do you know anyone like that? Is that you? Well, that's one of the personas out there. Now, next up, we have the investors who do it mostly out of a sense of obligation. The obligatory investor. They feel fortunate to have surplus, but with it also comes this sense that they really should be doing something good with it as well. Investing for these people is what they do, almost out of a sense of duty more than anything else. Considering the effort, especially, that it took to accumulate the money in the first place, the last thing these people want to do is watch inflation erode the value of it over time. They need to be making the best use out of what they have. The obligation to invest comes from trying to take care of their kids, but it can also happen to please parents, especially when this thing called an inheritance is involved. Now, some investors are chronic builders. They see money as a tool, something to build something bigger with. They see money just sitting there and it drives them crazy. With these types of investors, the risk is that they build even with no purpose, and they end up risking that which they already have just for the sake of activity. Now, fortunately, investors who view money as a tool like this do build great things, and without their vision, some households wouldn't even have a chance at wealth. Now, next up, we have the money as a comfort investor. These investors like to collect more than they like to deploy. They find it difficult, in fact, to use money as a tool unless there's a well-defined safety net. Money as a comfort, people often grow up with parents who made mistakes with money, and so it's reinforced a need to focus on the nest egg alone rather than the goose who could lay more eggs if they really let it loose. These types of investors can really balance out the builder investor as well. Next up, we have those who invest much like they shop at a yard sale. They only expect really an average rate of return. That's all they ask for, because compounding returns gradually over time is what they trust in. It's not about being smart, it's all about the lowest fee possible with these people. And why not? There's more available, though, for those willing to do more, but hey, that's not everyone's gig. Next up, we have the party today, but not tomorrow investors. Often, lifestyle moves are wrapped in a thin veneer of financialized logic to justify satisfying the wants of today over the needs of tomorrow. These party today but not tomorrow investors say that they're determined to build passive retirement income for the future, but they'll also travel overseas once a year, and they're often sporting the latest car. Again, why not? And who are you or who are I to judge them? You never know when your number's up after all. Now, there's a lot of investor personalities out there, and there's no right or wrong way to go about it. Some focus only on their household and the items they can control, yet others focus on the macro and attempt to position themselves for gains. It's important to remember that there's no right or wrong way to invest, and we all likely exhibit some of these traits at different stages of our lives. It's just part of it. Now, what I'd like to do is I'd like to answer an obvious question that maybe isn't obviously answered sometimes, not by me anyway, and the answer actually isn't going to be complicated. What is the question? Why do our investments grow in value over time? Now, I have a lot of complicated ways of answering this, a lot to do with a top-down approach. Let's actually keep it really simple and answer the question of Why do our investments grow in value over time? Investing your money means acquiring assets. These could be individual assets or investments, or it could be a collection of assets all at once. These assets could be shares in a company that you can purchase through an online brokerage platform like Sharesies or Hatch, for example, here in New Zealand. Now, there's a special offer for these platforms if you want to sign up for the first time, and you can find them in the show notes via some affiliate links. Alternatively, though, you might opt to invest in a collection of assets all at once. These are commonly referred to as managed or mutual funds. These funds can be accessed through various channels, including your retirement account, like KiwiSaver here in New Zealand. Financial advisors can also access these for you, or you can access them on other online platforms or even directly from the fund manager themselves. An asset, though, is defined simply as something that puts money in your back pocket. Ideally, the returns are more than what the initial costs or ongoing costs are in the future. For instance, if you buy shares in Apple, you are entitled to a portion of the company's profits, known as dividends. Another way to profit from this investment or this share is through capital gains. If the market perceives a bright future for Apple, then the demand for its shares in the future may increase, leading to a rise in the share price. Therefore, you could potentially sell your shares at a higher price than what you initially paid for it. So there's dividends, and then there's capital appreciation or gains in value. If the dividends are then reinvested, in other words, if these dividends are converted into more shares of ownership in the company rather than just taking cash out, then your investment returns will begin to compound. Or another way of saying that is that your returns start earning a return too. Now, apart from shares in companies, there can be many types of other asset classes. Anything that puts money in your back pocket, and in theory, this includes yourself, should be considered a financial asset. The value of that asset can be calculated by working out what the streams of income will be in the future that it can produce. Houses, businesses, power companies, gold, and even Bitcoin can all be considered assets. But some assets don't produce much income, also known as yield, at all. Some have strong capital gains or growth potential. Some assets provide a lot of yield, but never really rise in value. Take your savings account as the best example of this. You'll make some return in the form of interest over time, and you're not really taking a lot of risk in the process, but the value of what's in your bank account isn't growing. So that's a simple explanation, though, of investing that hopefully covers all the main points in a very short period of time. The name of the game is to get your personal finance sorted so that you're spending less than you earn after tax, so that you can buy assets gradually over time. It's not that exciting at the start, but eventually, like even over decades, you can actually accumulate meaningful amounts of money by investing. Investing in assets is like charging batteries, which are later discharged to fund a life independent of having to go to work for income. Think of your weekends as dress rehearsals for a 30-year period of time that will come at some distant time in the future. It reminds us that we need to get good at living off of provision that we've accumulated slowly over time. That's what our retirement can be thought of. It's when we're discharging those batteries that we've charged up our entire working lives. So yeah, today I just really wanted you to know that no matter what kind of investor you are today, you can become a different, hopefully better investor tomorrow. The results that you have today, no matter what they are, likely stem from a set of skills that you have or you developed at some stage. Maybe a set of skills to earn income or good set of relationship skills to get into where you are or whatever. But if you want better or if you want different results, you're going to need different skills. And I believe from the bottom up, micro first, we should be improving as investors all the time by bringing more of who we are to the table. And that's what this podcast series is about. Now, on a Monday, I tackle it from the top down, macro first. Now, somewhere in the intersection between what you can control and what you can't sits the opportunity for you to develop the skills that you need to get to your next level. I hope you enjoyed that short one today, and it was a short one for a change. Fantastic. We'll catch you on the next one.